EM growth was actually rather strong in the first half of the year. It exceeded expectations. We're expecting a deceleration in the second half of the year, but full year growth around 4.2% should be actually flat to 2023. The deceleration process that started in 2023 is starting to slow down in 2024, and that is going to limit how much more monetary easing EM central banks are going to be able to deliver. Plus, there's the huge question mark of when the Fed starts cutting itself. So the second half of the year is going to be more challenging for EM central banks. Elections are clearly a big thing to watch. There's been several elections across emerging market economies and in some developed market ones that have triggered some volatility in markets. The big one to come still is the US election in November. That is, given the talk of more isolationist policies on the side of the US administration, actually whoever wins is probably going to challenge policy making for EM economies.
I believe that the recent pullback in commodity prices was just a pullback. So number one, it's agricultural commodities. Second on our list is oil. So the balance will be tightening very quickly. Into the third quarter, demand remains very strong, though we would have to be very explicit that majority of the move has already happened. It's behind us with 12% appreciation in the oil prices. In the third place is precious metals. It's gold and silver.
We are bullish on the dollar going into the second half of the year. The reason for that is that the dollar continues to retain a significant yield advantage and a growth advantage compared to the rest of the world. So the dollar currently yields more than 45% of the currencies globally. That yield advantage is growing because other central banks are cutting. The Fed is not. You also have a growth advantage because even though US growth is moderating, it's coming off very, very strong levels. Whereas the rest of the world, it looks like even though growth had been improving, for example, in Europe earlier in the year, that's now started to run out of steam with the latest drop in the PMI. And China growth continues to stay fragile. And I think US elections actually adds more upside risks to the dollar because of what the ramifications could be from trade conflict and tariffs, as well as the Russia-Ukraine policy. So both of those would end up actually being net dollar bullish if certain policies were enacted. The second part of our FX outlook is really around yield compression. And the idea there is that you had a couple of years of investors engaging in yield-seeking behavior because the yields of the very highest yielding complex of FX was very, very attractive. But now central banks are cutting rates. 80% of central banks will be cutting rates this year, and that yields are compressing as the year progresses. And so that means that yield-seeking behavior will no longer be as attractive, and people will look for other signals like growth divergences or politics or geopolitics will end up mattering more